Hey everyone, it's Julie here with TipRanks, and today we're taking a look at two strong buy dividend stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. I hope your week is going along great. Today we're taking a look at two energy stocks that both pay a healthy dividend and come in with a strong buy consensus from Wall Street with some price targets that would imply some double-digit upside potential. We found today's stocks on the TipRanks Stock Screener. Found right at the top of the screener menu, I wanted to find stocks that had an outperform rating on the TipRanks Smart Score, double-digit upside potential, a strong buy consensus, and a high dividend yield. That gave us our list down below. So today we're going to take a look at these two companies, what it is that they do, those dividend details, and of course what Wall Street analysts are predicting for the stock's future. If you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. You can also try the stock screener for yourself over on the TipRanks website or on the TipRanks mobile app. Links to download are in the description below. Let's jump right into our two strong buy dividend stocks. First up, we're taking a look at Coterra Energy. They trade under the ticker CTRA, currently priced at $25.69. We did talk about this stock once before, back in February here sometime. Over the past year, they're up 7.6%. In the last 6 months, they are slightly in the red, down almost 4%, but gaining in the last 3, jumping up over 13%. They do score an 8 out of 10 on the TipRanks Smart Score, with increased hedge fund activity and positive crowd wisdom. Coterra is an oil and gas exploration company operating in the United States. They sell their oil, natural gas, and natural gas liquids to various customers, including industrial clients, local distribution companies, oil and gas marketers, and pipeline companies. They emphasize sustainability in their operations with efforts towards reducing their environmental footprint and providing transparent business practices through ESG considerations. They are operating across 3 core areas in the U.S., including the Permian Basin in West Texas and southeast New Mexico, the Marcellus Shale in northeast Pennsylvania, and Anadarko Basin in Oklahoma. Coterra says that they are committed to sustainably growing their dividend over time and plan for a minimum of 50% return of annual free cash flow through base dividends and buybacks. And that dividend has seen impressive growth in recent years, with a 5-year compound annual growth rate of nearly 20%. Their current quarterly dividend comes in just shy of 21 cents per share for a dividend yield of 3.38%, which is ahead of the sector average, and a payout ratio of 48%. They do have payments going back 34 years. They shared their Q3 earnings report on October 31st. They did come out with mixed results with a slight miss on earnings, but did also increase their production guidance. They reported Q3 earnings per share of 32 cents, falling just 1 cent short of analyst expectations, while revenue of $1.36 billion did beat by $90 million. During the quarter, the company did repurchase 4.3 million shares for $111 million, and looking forward, they increased their full-year production guidance midpoint for BOE, natural gas, and oil, with the midpoint now assuming 12% year-over-year growth. Management said that they continue to exceed their 2024 plan and have strong momentum with significant optionality heading into 2025. And just last week, we did have a 5-star analyst from JP Morgan increase their price target on the stock while maintaining their buy rating. In 2025, the firm expects natural gas producers to benefit from 3 powerful secular demand trends: the build-out of significant liquefied natural gas export capacity, rising power demand from electrification, and coal-to-gas switching. They updated exploration and production models through 2030, which supports their view of long-term gas prices above $3.50 per MMBTU. The Coterra stock does have 19 current analyst ratings, coming in as a strong buy based on 16 buys and 3 holds. And the average price target of over $32 implies an upside potential of 25%. Looking at those price targets down below, in recent weeks we have had several analysts bump up those price targets. Our high-end price target is $38 from Siebert Williams for an upside of about 48%, while our low-end price target does come from back in October at $26 for a slight upside of 1%. And for our second strong buy dividend stock, we're taking a look at Schlumberger. They trade under the ticker SLB, currently priced just above $41 per share. They are in the red this past year, down about 14.5% and about 5% in the last 6 months. We did talk about these guys back in September here sometime. In the last 3 months, they gained slightly, up 3%. They score a 9 out of 10 on the TipRanks Smart Score, with a large increase in hedge fund activity and bullish blogger sentiment. Around for nearly 100 years, Schlumberger is a global leader in oil field services. They provide technology for reservoir characterization, drilling, production, and processing to the oil and gas industry. They offer drilling services, well construction and completion, production management, integrated project management, digital solutions, new energy ventures, and equipment and software. They operate worldwide, providing these services to major oil companies, national oil companies, and independent operators, ensuring that their operations are both economically and environmentally sound. Schlumberger has been paying a dividend for 15 consecutive years, though they did have to cut that dividend in 2020 due to the pandemic. But over the last few years, they have been aggressively growing it back. Their 3-year compound annual growth rate is 30%. And their current quarterly dividend comes in at 27.5 cents for a dividend yield of 2.45% and a payout ratio of 32%. Their Q3 earnings report came out on October 18th, and they also had some mixed results with an earnings beat but a slight miss on revenue. Q3 earnings per share of 89 cents beat expectations by 1 cent per share, while revenue of $9.16 billion did slightly miss by $140 million, but increased 10% year over year. The company saw cash flow from operations of $2.45 billion and free cash flow of $1.8 billion. Management said that they delivered strong Q3 results, achieving earnings growth and margin expansion in line with their full-year adjusted EBITDA margin goal of 25% or higher. Just a couple of days ago, we did hear from a 4-star analyst at DBS who reiterated their buy rating. They noted a couple of the company's recent strategic acquisitions, saying that their acquisition of Acre has begun to contribute positively to revenue, and their acquisition of ChampionX is expected to enhance their capabilities in the production chemicals and artificial lift technology sector. They said that Schlumberger is well positioned to benefit from ongoing and future developments in the global energy sector, and that their strategic focus on capital-light operations and robust investment in digital transformation further support their growth prospects. With 16 current analyst ratings, the SLB stock does come in as a strong buy with 14 buy ratings and 2 holds. And the average price target of $59.41 implies an upside potential of 44%. Looking at those recent ratings down below, on the high end we do have DBS here at $64.50 for an upside potential of 56%, while our low end price target is here in October, a hold rating at $49 for an upside of 18%. So that is a quick look at 2 energy stocks, both paying a dividend and coming in with a strong buy rating from Wall Street. Let me know your thoughts on these 2 companies in the comments down below. I always love hearing from you guys. And of course, please remember that these videos are never a suggestion to buy or sell any specific stock, so please make sure you're always doing your own research and due diligence. Thank you guys so much for watching. I hope you have a fantastic day, and I'll see you back here next time.